why are gold and silver falling when the reasons to own them are growing? So let's begin with the mystery. Obviously, wars continue in Eastern Europe and clearly in the Middle East and more places. Debt is rising. Governments are borrowing more, which means they're expanding the money supply and creating more inflation, which is proving sticky. Shocking. Central banks are buying gold at the highest levels ever. And silver is needed in more and more parts of the modern economy to build out these data centers, etc. And frankly, confidence in government, in the currency, in the system, it's being sorely tested. And those should all be reasons for gold and silver to rise. What's going on? Yet suddenly the prices can fall, sometimes pretty violently. So what is the market really trying to tell us? Have the reasons to own gold and silver disappeared? No. Has physical demand collapsed? No. Or is the price on the screen measuring something very different from what most people believe it's measuring? Because what looks like weakness in the metal may actually be stress somewhere else in the system. And frankly, once you understand what the screen price is really showing you, those declines become far less frightening. You don't see me frightened of them, do you? And frankly, the only reason why I pay attention to them at all is because you pay attention to them, and I need to be your guide through this. So today, we are going beneath that price to replace confusion and fear with, I don't know, what a concept, understanding and educated choices. After giving up our right to convert dollars into gold in 1933, in 1974, Americans were about to regain the legal right to own physical gold again. U.S. officials asked London gold dealers what they expected to happen when that was lifted, when that ban was lifted. And their answer, remarkably revealing. They expected a large gold futures market, a paper, an intangible market to develop. That's what they were going to push. They expected the physical holding of gold to become relatively small compared with contract trading. And that's what's happened. And they believed that the volatility created by those future contracts could discourage long-term physical ownership because they don't want you and me to think about gold as money, which I do. This is money. They want you to think about this garbage as money. Well, it ain't money. It's currency. Think about that. Before the market fully developed, insiders already understood how it could change public behavior. So instead of asking, how many ounces do I own? People would increasingly ask, what did the price do today? The focus would shift from ownership to price movement, which falls right in with their plan. From wealth preservation to trading and the financialization of every single asset on the planet. That means it's just turned into a financial product and it's about trading.
Back in 1974, when Americans got their legal right to own gold again, U.S. officials reportedly went to London dealers and asked what would come next. Their answer? A massive paper futures market would spring up, one that would dwarf actual physical holdings, and the volatility that came with it would push people away from holding real metal. That's more or less how it played out over the following half-century. The public shifted from thinking in terms of how many ounces do I have to what did the price do today? Gold stopped being seen as savings and turned into something traded, a financial product stacked on top of a physical commodity, with that top layer expanding far faster than the metal it's supposedly built on.
I believe physical possession is critical. And then you want financial exposure? Rock and roll hoochie coo. From physical possession to financial exposure to a trade, from ownership to a trade. It does not require a single secret meeting or one master plan, but it tells us that the effect of the system, it was understood. And a large contract market could become more visible than the physical metal itself. But was that the only prediction? Or can we actually see what happened? I don't know. Once gold became both a physical monetary asset and a heavily traded financial instrument. Let's look closely at what changed after 1974. This is the purchasing power versus the spot gold contract. Now that white line is the purchasing power of fiat currency. Over time, well, it keeps falling because they keep doing this kind of thing. That gold line is the visible dollar price of this fixed price of gold when it was fully and totally a monetary asset. Over the long term, gold moved dramatically higher as the currency bought less and less and less. But the journey was anything but smooth because these are contracts. So we'll see the surges in there and we'll also see the collapses. We'll see these contracts recover, move sideways, and then surge again. So there are two things that were happening at the same time. The long-term direction reflected the weakening purchasing power of the currency. Even though it's a contract, look at that. It still certainly does that. But the short-term path was increasingly influenced by trading flows, leverage, liquidity, and emotion. A fund may sell gold because it needs cash. A trader may sell because a model changed direction. A bank may reduce exposure because its risk limits tightened. None of those actions means the dollar suddenly became sound. And the dollar, by the way, is currency. It's not money. None of them creates another ounce of physical gold. And yet, they can still move the visible price. So I really do want you to understand that the price and the monetary value are not always telling you the same story. The price may be telling us what leveraged traders are doing today. The monetary value tells us why gold has endured across centuries through so many currency resets, over 4,800. And that is hopeful. Because a volatile price does not mean the asset has lost its purpose. It simply means that we have been watching the wrong signal. What a concept. So how did financial trading become powerful enough to dominate what the whole world sees as the gold price? The answer is hidden in something the physical market cannot do.
Since 1974, gold's price has spiked, crashed, gone flat, and spiked again, a bumpy line that nonetheless traces the dollar's long, steady decline in purchasing power. But two separate forces get tangled up inside that single price line: currency debasement playing out over decades and short-term trading activity. Leveraged funds, margin calls, and shifting risk models can all push the price around without changing the actual physical supply by even an ounce. A bank cutting its exposure or an algorithm flipping a position doesn't create new gold or strengthen the dollar, it just moves a number on a screen. Confusing that number for the whole picture is where people go
Shows
wrong.
the enormous growth of precious metals derivatives just in the FDIC insured banks since 2001. This is from the Office of the Comptroller of the Currency. I show you this regularly. And while I cannot tell you the exact leverage used, can you see how a surge in buying or selling contracts could influence that contract price? Can you see that? Because that's not the physical, but at the exact numbers. But those exact numbers are far less important than the structural change. Because frankly, a physical ounce of gold's got to be mined. It's got to be processed, refined, transported, stored. And someone who owns it must be willing to sell it. Are the central banks selling their gold? Only if they need to survive. That's a whole big point of gold, isn't it? But a financial claim can be created with the opening of a contract. That's it. Ba-bam! All sorts of new gold now exists. And exposure can expand without another ounce being produced. And this leverage allows a relatively small amount of capital to control a much larger position. We've talked about this so much. But that means that the contract market can create emotions and enormous flows of buying and selling. See that perception management? And because the market with the greatest volume often produces the marginal price, those flows can dominate the numbers we see on the screen. So the screen may look like it's measuring physical supply and demand. No. But in the short term, it is really only measuring the movement of leveraged money. Ooh, there's the next shiny object. Ooh, there's the next shiny object. Claims can multiply. Metal, not so easily. This is the difference between financial liquidity and physical supply. And those two areas will be clashing. I can't tell you when, but I know that they will be clashing. Because financial liquidity can appear limitless. Doesn't it appear limitless? I mean, what is the limit of that? None. But it still sounds theoretical. So let us make the leverage visible, because how much contractual gold is outstanding compared with the unpledged register metal beneath it? So here's the contrast. These are outstanding. Just the COMEX gold contracts represented approximately 38.37 million ounces compared with approximately 12.92 million ounces of unpledged registered gold. That means that could be delivered out. Nearly 3 contractual ounces for every unpledged registered ounce. Now, look, a lot of you are going to say, what about the world debt clock and showing all of that leveraged? And, oh yeah, by the way, what about the Bank for International Settlements showing 62,000 ounces for every 1 ounce of physical that exists? This stuff is so hidden. So I'm showing you something extraordinarily conservative. But now I want to be even more precise, because this is not a prediction that every contract holder will demand delivery tomorrow, since most contracts are closed and it's just about rolling them over and capturing any gains in this crap, right? But that's the hidden assumption. The system does not need 1 ounce immediately available behind every contractual ounce. That's fractional reserve lending. It needs most people to remain satisfied with the claim. It needs you to remain satisfied with the claim. Do you get that? Additionally, leverage creates the appearance of supply without creating any more metal. More contracts are not more gold. More liquidity, more money flowing into the system is not more gold or silver. A deeper market in claims does not make the underlying physical asset less finite. And once you see that, a falling contract price is no longer automatically proving that physical gold has become unwanted. It may simply show that financial claims are being sold, whether it's margin calls or any other reason. A new shiny object over here, it doesn't matter, because now the mystery becomes even more interesting, frankly. Because while the claims remain large, what's been happening to the physical gold, underneath them? You can see that the physical inventory rose sharply, but then from the peak, the direction changed, didn't it? Inventory began moving lower. Registered gold is associated with delivery warrants. That means you can deliver them out. But eligible gold meets exchange standards, but it's the owner has not necessarily made it available for delivery, so they can't sell it. Neither category means every ounce is freely offered for sale. Understand that. If there's a run, they got a big problem. But the trend matters because the financial claims remain large while the physical inventory has fallen from its peak and continues to fall. And that doesn't mean that the system must fail tomorrow. It means that the cushion underneath it is smaller, and it makes the behavior of physical owners that much more important. They don't want you to take physical possession of the gold, because when you do that, you're outside of the system.
The Silver Institute's 2026 World Silver Survey marked a sixth straight year of deficit, this time about 46 million ounces, meaning the world is using up more silver annually than its mining and recycling combined. Unlike gold, most of that silver doesn't just sit in storage. It ends up soldered into phones, solar panels, EVs, and defense electronics, gone for good. January 2026 gave a glimpse of what that pressure looks like in practice. More than 33 million ounces left COMEX's registered inventory in a single week, and that pool never bounced back fully. The paper market can print whatever price it wants. It can't summon back metal that's already been used.